I'm Andrew with Jesani Wealth Management, and probably the simplest component of our 3D multi-asset allocation strategy is arbitrage, which falls under the second dimension. And arbitrage in its most basic form is simply the same asset is valued higher or lower on one exchange or one market versus another exchange or another market. Really simple example would be like Toyota Motor Company, which of course is a Japanese company. It trades on the Nikkei 225, but it also trades on the New York Stock Exchange through what's called an ADR, American Depository Receipt, which is basically a certificate that allows you to buy the real Toyota Motor Company on the Japanese exchange. And typically, even though the actual share price is different, the value is the same. But there may be scenarios where there's a fraction of a cent difference in those two prices, and a statistical arbitrage firm, a lot of times using algorithms, will go in and in large volume, sell at the high price and buy at the low price. So a simultaneous transaction, thus keeping the spread between the two prices. Now, one of the more common market theories out there is the efficient market hypothesis. It's a portfolio management theory, very basic. It's also similar to the capital asset pricing model, which states that the market is all assets in the market are perfectly priced at that particular time, and the market is 100% efficient, which means that as an investor, it's impossible to go out and find an underpriced asset and then sell it once it's more fairly priced. Completely the opposite is the arbitrage pricing theory, which states that there are inefficiencies in the market from time to time, and there are underpriced stocks or assets as well as overpriced stocks or assets. So that allows an investor, of course, to own more underpriced assets and get a better return than the overall market. And there's an interesting relationship between the two because we know arbitrage exists. It's difficult to find sometimes, usually limited to institutional investors, at least in the public markets. But we know it exists, and those funds taking advantage of that arbitrage narrows the spread and kind of takes away that small profit to be made, thus turning it into an efficient market and following along with the capital asset pricing model. So probably the most common place for arbitrage scenarios, at least in the public markets, would be the Forex exchanges, a very decentralized, very large exchange with a lot of international exposure. And usually they're using statistical arbitrage, which is really just computers doing the trading, looking for those small differences in asset pricing. But probably a more simple one, and also very common, that retail investors can take advantage of is merger arbitrage. So when a company gets bought out, typically the stock goes up very close to that buyout price, but it doesn't actually hit that buyout price. You just have to wait until the share conversion or the exchange. The reason for that is, of course, there's always the potential for that merger, acquisition, or buyout to fall through and the stock go back to where it was pre-buyout news. Perfect example is Twitter right now. It's trading in its 30s. Elon Musk made a bid to buy out at 54.20. The stock went into the low 50s, not all the way to 54.20. And lo and behold, it looks like, still to be determined, but it looks like the deal is falling apart. And now Twitter is back into the $30 range. But that transaction can go both ways. If an arbitrator feels that the transaction is going to fall through, they could certainly short at the higher, buy at the lower, or buy at the lower if they're confident in the transaction and make the spread between the actual trading price and the buyout price. Also quite common, there's a lot of funds that do this, is convertible arbitrage, which is using convertible notes or convertible bonds. So let's say you have a convertible bond A, that you're able to convert into stock B at $1 per share. And today, stock B is trading at $1.01. Of course, you convert that bond at the $1 price, similar to like a warrant, sell the stock, and you make that 1 penny gain on that transaction. And a lot of times, again, these are very, very small profit margin transactions done in significantly large volume. But also on the private markets, arbitrage exists as well, particularly in real estate. Usually in real estate, though, there's some type of value add happening to quickly increase the value of a particular asset. But in private equity, a common way that they increase the valuation is called multiple arbitrage, which is where the fact is that larger companies with the same EBITDA trade at a higher valuation than smaller companies. So all else the same, the bigger the company, the higher valuation or multiple that it has. So what private equity firms will do is go purchase a company, go in as an active investor, and then simply roll up other companies into it, not changing those other companies or any of the business, but just combining them to allow for a larger cap company and thus increase the multiple that it would sell for. The other way could be that, and private equity does this as well, is different sectors of the market trade at higher or lower multiples depending on what product they're selling. So let's say a company that manufactures and sells windows for boats is bought up by a private equity firm. Well, without having to really change the company very much, that private equity firm will instead shift the company into producing smart glass for the new cell phones, for a smartphone. Now, because that goes into kind of the technology space, whereas boat windows is just industrials may trade at an average of an 8x multiple, where the technology space may be more around an 11 multiple. So as an investment firm, we're more so taking advantage of arbitrage in the private markets, but there certainly are opportunities out there, and having the connection and the deal flow to identify them is certainly key. So again, my name is Andrew with Jesani Wealth Management. You can always reach me at 954-800-8552. Thanks, everyone.